no matter how many protests there are, no matter how much concern there is about US-China, and no matter the concern about also second wave of coronavirus, equities are going up. What are they looking at? Is it central banks?
That's a very good question, and clearly the key question at the moment. And there are a lot of people who are scratching their heads and they're saying, how is it possible? The economy is on its knees, unemployment is rising, defaults are coming, and yet the equity market is up almost 30%. And the answer is that's exactly what you should expect, because what matters is not so much is the economy in a bad state or not, because that's already in the price. The question is the situation getting better or is it getting worse? We've seen a clear inflection point in the economic cycle. All activity indicators troughed in the middle of April. Activity is now recovering because the virus has faded, economies are being reopened, and that's what equities are pricing. We have seen the trough, and activity is starting to pick up.
Do you see value, or are you expecting a correction, Sebastian?
We think, first of all, the value is the rally is justified, and we also think it has further to go. And here's a very simple way of thinking about it. The main driver, and Francis, you and I, we've discussed this many times, the main driver of the European equity market is the rate of change in the PMI. The PMI in the euro area currently is at still quite a depressed level of 30. The market, after an almost 30% rally, is priced for it to rise from 30 to 40. But the key thing to remember, a PMI at 50 means flat activity month on month. So if activity now comes back, the PMI should rise above 50, but the market is only priced for it to be at 40. If the PMI rises above 50, as we expect, that's consistent with another 15% upside for European equities. So we remain positive on the market.
Sebastian, where do you see the most value? So do you look at regions? Asia started reopening before some of the Western economies. So is there more value there, or do you worry about the US-China trade relationship?
So we are mainly focused on the European equity market. From a regional perspective, we see roughly as much upside for Europe and the US, but we think EM is set to outperform simply because the main determinant of EM's relative performance is the dollar. The dollar has benefited tremendously from the spike in global uncertainty to an all-time high. If the uncertainty index now fades, there's a risk premium that has to be priced out of the dollar. If the dollar weakens, that's good for EM, it's good for commodity prices. And within the European equity market, we have a lot of investors still clinging on to the defensive recession plays, effectively the growth names, and especially the pharma sector, which has done tremendously well for 2 years on the back of falling bond yields and a rising dollar. We think there is now a rotation due that has already started since the middle of May, with the beaten-up financial sectors outperforming and the high-quality names like pharma underperforming. So as I said, that has started, and we think this rotation out of pharma into financials has further to go.